Even after last week's drop in the S&P 500 for the large growth companies like Nvidia, like Microsoft and Apple, when we take a look at their valuation, each one of them still returns a grade of an F, whether that's Microsoft, whether that's Nvidia, as well as Meta and any others, essentially showing there is limited upside and they do trade at a significant premium to the sector median. In today's episode, we are looking at 7 undervalued growth stocks. Each one of these have significant upside that you really need to consider for the portfolio. Now, the first one, Lululemon Athletica, this is down around 28% over the last 12 months. It now trades right at its new 52-week low, and we get a double buy rating, seeking alpha Wall Street, although we do note a hold from Quant. And in terms of the forward P, well, it is 19.56. For those that want to know, the S&P 500 right now is trading at around 23 on a forward basis. And over the last 10 years, this is a company that has significantly outperformed the S&P, up 627%. And in fact, we can see it has come down from its all-time highs a few months ago, in fact, December 23, where it sat at $515. Now, a few things we like to do with each one of these growth companies. First one, look at their earnings report. Nice to note for Lululemon, they have beaten over the last 4 quarters. 4 out of 4, 100% track record, and over the next 3 quarters at a minimum, they are anticipating double-digit increases to the earnings per share. Now, if you want to look into the future, well, January 26, if you do have confidence based on their previous performance, that forward P will be lower, down to around 17.57. Now, a few things to note with this company in terms of their metrics. First one is the free cash flow per share. As always, we want to see consistent increases over the longer term, and that is what we get. In fact, it's gone from 135 in 2015 to 13 in 2024, and look, the upward trend is expected to continue over the next 12 months to around $14.70. In terms of sales growth, well, very strong to see, double-digit increases every single year, and in fact, we're not getting a decreasing trend. We are in fact getting more of an increasing trend, although we do note it has started to slow down from the utmost peak that we saw in 2022. So numerically, as you would imagine, it has grown very rapidly, in fact more than 4 times over the last 10 years. Shares outstanding, whilst not very consistent, they do return some excess cash through share buybacks, but it is fairly minimal and therefore fairly trivial. ROIC, very strong. One of the best, in all honesty, that we have seen on this channel in terms of consistency and very high numbers. At a minimum, 10% or more is what we deem for this metric. Just give us faith. Management are able to effectively allocate their capital. In the high 30s, low 40s, looking very strong. This is incredibly attractive for potential investors. Operating margin, good as well. We want to see a minimum of 16%. Has started to increase over the longer term. That is what we ideally do want to see on the channel. Increasing revenue as well as increasing margins. Free cash flow margins looking very strong as well. Above the 5% minimum, even after recovering from that drop in 2023, 17% in 24, 18% on a trailing 12-month basis. The final metric that we always look at is the net debt to EBITDA. This gives us confidence on the balance sheet strength, and a lot of confidence we are seeing here. Over the last 5 years, this is 0. Now, these numbers represent the number of years it would take the company to pay off all of their debt net of cash on hand. It wouldn't even take them 1 day since 2020, and over the next 12 months, again, not even 1 day. So very good there when briefly looking at a balance sheet analysis. In terms of their valuation, well, we get our intrinsic value at $383. How we get to this? Well, we do put it through the DCF model where we have the free cash flow year on year. We then have the average growth rate of 19%, and with our discount rate of 8%, using 3 different factors, a low, medium, and high, we then get the free cash flow. So today's episode, we have gone a little bit more conservative than one of our more recent episodes at 18%, and then by using that discount rate, we do get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see the intrinsic value of $383. Now, for those that believe that is way too optimistic, at that 16% level, as we can see here, you would ultimately getting an intrinsic value of $340. That would deem to be 21% upside, and as we can see, just to show you, for 20% as we have here, $432. Now, in all honesty, you could argue and go for an average growth of 19%, and that would give you an intrinsic value of $407 that we have gone through in previous episodes. But to be even more conservative, we are going to go for a slightly lower rate at 18%. And don't forget, you can grab a copy of this model by clicking on the pinned comment below, running in your own numbers. So based on that 18%, we do get an intrinsic value of $383, with that current price sitting at $280, a new 52-week low. We then use a margin of safety. As always, 10% is the starting point if the company has a wide moat, strong financial metrics, and good forward-looking data. Well, if you believe so, it is a buy up to $345. Then we keep going till it's near the current trading price. And what we ultimately see in today's episode, you are getting at least a 25% margin of safety up to $288. At 30%, you would have to wait from $268. So in today's episode, while we have a 25% MOS or somewhere between 25 to 30, Wall Street are very bullish on this company. They believe the market is overreacting. Their upside is 45% with a price target of $405. As always though, let us know your thoughts as we do go along this one as well as the next 6 growth stocks today. We then move on to Celsius Holdings, another one which is now trading right there towards its 52-week low. We have a double buy from Seeking Alpha and Wall Street, although we do note a sell from Quant. In terms of the forward P, just above 46. We'll take a look at that earnings shortly as well. Over the last 12 months, well, they are up around 2%. In fact, just over the last month, they are down 20%. And over the last 10 years, we can see up 23 or nearly, in fact, 23,000%. So again, very good performance over the last 10 years. Whether or not they'll hit that again over the next 10, that is something that unfortunately past performance does not tell us about future performance. We do also note their all-time high is around $95 just a few months ago. Now, in terms of their earnings report, well, what we can see over the last 4 quarters, they did miss one of them in quarter 4 23, but the more recent one they did beat, so 75% track record. And over the next quarter, they are anticipating double-digit increase to the earnings per share year on year. Now, December 25, if they do hit their targets, 142 estimate, the forward P will come down to around 34.87. And one of the reasons why it is valued very highly is due to the growth. As always though, whether or not that is warranted in terms of the valuation is something we can put through in the margin of safety. Free cash flow per share, well, they were pretty much negative from 2014 to 2021. They did go positive in 2022. And in fact, while there was a small increase into 23, over the next 12 months, it is expected to nearly double. A great sign to see. That is a very good metric that we like to note. And the sales growth, as we mentioned, is fast growing. And you could argue it is slowing down since the peak of 2021. Nonetheless, 102% in 2023, 81% on a trailing 12-month basis is still very, very strong. Numerically as well, incredible growth over the period. Now, you probably wouldn't care that they would have diluted your position as a shareholder over the last 10 years, primarily given the fact that they would have returned you on share price alone around 22,000% that we just saw. ROIC, well, this denotes essentially the company hasn't turned a profit until 2020. 2023, though, nice to note, 24%, very strong, just something we want to see in terms of consistency moving forwards. Then we get to the margins. Again, no surprises, as we said, it is a negative margin for the majority of the last 10 years, given they were loss-making. 2023, though, nice to note that 20% operating margin, and free cash flow margin recently turning positive, 8% in 2023, 18% on a trailing 12-month basis. Does look positive, especially when we will hope to see that consistency moving forwards. Net debt to EBITDA looking great as well. Since 2019, it is 0. Over the next 12 months, again, anticipated to be the same. So a very strong balance sheet. Now, when we talk about the valuation, our value is around $72 in today's episode. And putting it through the DCF model, we have 3 different rates, a low, medium, and high. Going for the medium, that is 30% estimated growth to the free cash flow over the longer term. We can in fact see an intrinsic value of $72. As we mentioned, that would be upside of around 45%. But for those that believe that is in fact too optimistic, 25% we can see around $53, not too far off the current trading price. And for those who are a lot more optimistic, 35% would essentially indicate upside of 94%, in fact nearly double the current trading price. So we'll take the 30% into the next slide, and when we get it into the intrinsic value, that 10% margin of safety does indicate a buy at $65, at 15% around $61, and then we keep going, and again a nice MOS in today's episode, pretty much a 13% margin of safety, with Wall Street indicating 66% upside Their price target, $83. Again, very bullish on this, similar to Lululemon Athletica. But as always, we are interested here whether or not any of these so far are ones that maybe you've added on the watch list waiting for a lower entry. Now, before we move to the next stock, just to let you know, we've released our latest free weekly article. The next one is coming on Monday. If you want access to this or any other articles, it is all completely free. You can click on the pinned comment below to sign up and read straight away. And one of our more recent articles, the 18 Undervalued Dividend Kings, does come with a free spreadsheet looking at all of the kings and the ones that we do believe to be significantly undervalued. Moving on then, we have Ulta Beauty. Now this one is down 17% over the last 12 months. Over the last 10 years, it is up 322%. Again, outperforming the S&P. We also get a double buy rating with the hold coming from Quant again. And on a forward P, it does look pretty attractive at 15.18. Now, when we take a look at their earnings, always great to see 100% track record. They have beaten over the last 4 quarters, although we do note over the next quarter it is anticipated to be single-digit negative growth, but over the next 3 that does turn into a positive. And as we can see, January 2026, their forward P will come down to around 13.8. Look at the metrics. Well, this isn't the first time we've looked at this company. It is very strong in my opinion. Free cash flow growth moving year on year, pretty much nearly 10 times over the last 10 years. Expected to continue that trend over the next 12 months. Sales growth as well, other than that COVID year where it did drop 17%, double-digit increases year on year. And when we do look at it numerically, we can in fact see nearly quadrupled over the last 10. Also nice to note that not only do they have a very small amount of shares outstanding, but they do consistently do those share buyback. It is one of the ways that they do use that capital allocation. ROIC again looking very, very strong. In fact, over the last 10 years, sitting around the 30 to 40% is very, very impressive. Margins also look good at a minimum around 16%. It has pretty much straddled around that over the longer term. And the free cash flow margin well above the minimum 5% that we want to see, 9% in 2024. Finally, balance sheet looks very good. Net debt to EBITDA. Now this essentially, for those that don't know, is the earnings before interest, tax, depreciation, amortization. 0.49 in 2024. So again, looking very healthy purely from that balance sheet perspective. Our valuation in today's episode coming to $485. And this is really interesting to note. Now we have gone for what we would say is very low growth rates in the model at 4, 6 and 8%. Now typically we would go for the medium rate, but we want to go for the even lower rate just to show you this is essentially where Wall Street's target is coming from, as their price isn't dissimilar from our intrinsic value. So they ultimately believe a growth rate of 4% over the foreseeable future, when their average growth rate is 48%, and just in the last year, or in fact in the last 2 years, we do see the low to mid 30s. So this is already incredibly, in my opinion, conservative, and with a 4%, we do get that intrinsic value of $485. Upside of 24%. For those that believe actually 6% is a lot more realistic, then you are looking at 564 with upside of 45%. Nonetheless, we'll take that 4% across into the final calculation, and the margin of safety at 10%, still a buy up to 437, 15% up to 412, at 20% pretty much at the current trading price. So right now, on what we would say is incredibly conservative metrics, you're getting a 20% margin of safety, with Wall Street deeming this to have 25% upside at $486. And for me personally, I do quite like the way management do use their capital allocation. As always though, let us know your thoughts below. We then move on to Uber Technologies, where we have a strong buy from Wall Street, a buy from Seeking Alpha and a hold from Quant, trading in the mid to upper end of the 52-week range with a very high forward P of 75. And over the last 12 months, it has accelerated. Over the last 5 years, it is up around 56%. Now, in terms of earnings, well, the last 4 very mixed. As we can see, they've beaten twice, although missed, in fact, in the more recent, as well as in quarter 3. So a 50% track record. But over the next quarter, they are anticipating some very high growth to the earnings per share. And when you do go all the way to December 25, that will drastically lower that forward P to around 32. So they do see a lot of growth just over the next few years. Then when we talk about the metrics, well, free cash flow, very positive to see it's gone from negative to positive. In fact, negative 11 in 2016, 165 in 23, expected to continue to 281 over the next 12 months. And the sales growth, although very, very inconsistent, it is still at a minimum double digits other than that 2020 COVID year. And we can clearly see some very rapid growth, in fact, around 10 times just from 2016 to 2023. Unfortunately though, they would have diluted your position over the last few years, as we can clearly see, with not the greatest share return over the same period. When we look at the ROIC, well, they haven't turned a profit for quite some time. 2023, the first year with the 5%. Hopefully, this is the start of them turning a very consistent profit, especially with the rapid increase that they are noting to their top line. Again, no surprises here with their operating margin going from a negative to a positive, and free cash flow margin, as we can clearly see, 2023, 9%. Again, that is healthy, but we just want to see that consistency. Finally, the net debt to EBITDA, 1.43 in 23, going much lower over the next 12 months. So a lot of these metrics are moving in the right direction. The only thing that we would ultimately like to see is some consistency. Now, the intrinsic value at $85, and in fact, that is not dissimilar from Wall Street, 86. They see around 29% upside over the next 12 months. In terms of where we've got to with the growth rate, well, the low, medium, and high takes a 20% medium rate, and given how much that has just increased over the last year, that is expected to continue the upward trend in the massive free cash flow growth. Now, discount rate at that 8%, we can in fact see $85 does imply 27% upside, but as always, for those that are very optimistic or believe these numbers are way too conservative, that is around 72% upside if they can maintain a 25% growth rate to the free cash flows. So at 20%, the intrinsic value, as we said, at $85 does give a nice margin of safety. 10%, $77, 15% at $72, and at 20%, again, not dissimilar from the current price, so 20% margin of safety with 29% upside. We then move on to Mercado Libre with another strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. Forward P around 48, trading in the mid to upper end of the 52-week range, up 35% over the last 12 months, and over the last 10 years, more than 1,693%. In terms of their earnings, well, 100% track record over the shorter term, always a good sign. And over the next 4 quarters, they are anticipating double-digit increase to the earnings per share year on year. And what we do note with the earnings per share estimate, it will get lowered in terms of a forward P at around 36 in December 25. Metrics, well, free cash flow looking very strong. We do see some massive growth, although a lot of this has come in the shorter term. One thing we do want to point out, over the next 12 months, though, it is anticipated to drop. In terms of sales growth, well, double digit every single year. Again, some of the questions you need to ask yourself with these companies is a lot of this sustainable when you do come to look at your own investment thesis and your own due diligence? Again, total sales have increased dramatically over the last 10. Shares outstanding, they would have diluted your position, although very minimal over the last 10 years. And ROIC, whilst it is inconsistent, nice to note from the negative of 2019 at negative 5%, it has started to increase year on year. And as we always say, if they can start to produce very consistent metrics, then this will be a great one to consider. Operating margin, well, very inconsistent, but again, moving from 2019's negative, it has turned out to be good in 2023, around the minimums we want to see. And the free cash flow margin looking very healthy over the last 2 years. But again, the theme for this company, when you do look over the last 10, has been inconsistency. Balance sheet, though, looking good, 0.57 in 2023, and over the next 12 months expected to come down to 0, so always a great sign to see. In fact, this is one of the things we do look at when we do a stock screener. In terms of intrinsic value, we're $1,932. In the DCF model, we've gone very conservative, 468, and in fact, we've used the ultimately lower end of 4%, just showing how conservative this is. And if they do hit that 4%, well, the upside is around 17%. But again, a lot of people may in fact say it should be a lot higher. Even at that 10% level, we can see that isn't too far off being double the current trading price, and that is ultimately lower than the average of 100% and lower than the last 2 years where they did see some massive growth to the free cash flows. Nonetheless, with the very conservative 4%, the intrinsic value not dissimilar from Wall Street, who see 23% upside over the next 12 months at a $2,030 mark, does give some nice MOS. 10%, 1738, at 15%, not too far off the current trading price, a few dollars shy. So 15% MOS for Mercado Libre with a 23% upside from Wall Street, and that is over the next year. We then move on to Duolingo, where we get a buy from Wall Street, although a hold from the other 2 analysts, with a forward P that looks incredibly high, over 100. It is trading in the mid to lower end of the 52-week range, up 9% over the last 12 months. And when we do look at their earnings, over the last 4 quarters, they have beaten beaten analyst estimates, quite healthy beat as well in the more recent one, and over the next two they are anticipating some incredible triple-digit increase to the EPS, and as we can clearly see, 2025 2.67 EPS, giving a forward P, although still very pricey, coming down all the way to 65.63. In terms of the metrics, well, nice to note, free cash flow has been growing very strongly over the last few years, expected to continue over the next 12. Sales growth actually pretty consistent over the last 3 years, in the mid 40s to the mid 50s, and when we look at it in terms of numerical values, it has gone from 71 million in 2019 to 531 in 2023. In terms of shares outstanding, though, they would have diluted your position, which they tend to do quite consistently on a year-on-year basis. ROIC, well, they haven't turned a profit yet, as we can see, although what we do note on a trailing 12-month basis at 2%, this could be the first year that they do, and again, that is shown through the negative margin that they have on the operating side. But on the free cash flow margin, we can see, especially in 2023, some very, very strong numbers. In fact, nice to note, on a trailing 12-month basis, it is expected to increase. When we look at the net debt to EBITDA over the last 3 years and over the next 12 months, zero, fantastic balance sheet. And as always, with any of these companies, do let us know if you want us to do a deeper dive. So the intrinsic value comes to $230. In fact, Wall Street incredibly bullish. Their price target, 257, does indicate upside of 47%. And when we look at the DCF model, we have an 18, 20, and 22% rate. In fact, right now on a 20% median rate, that is upside of 31%. But you can see just over the last few years, some incredible growth to the free cash flow. If that is expected to continue, then these numbers could be incredibly conservative. In terms of the margin of safety, then, based on these numbers, at 10%, a buy at 207, at 15% around 195, at 20% around 184. And we can see in today's episode, nearly at a 25% MOS. Again, as we said, Wall Street very bullish, 47% upside. We then move on to Elf Beauty, where we get a buy from Wall Street. In fact, very close from being a strong buy, would have to hit 4.5, and a double hold from the other two analysts, trading in the mid to upper end of the 52-week range with a forward P around 52.2. Over the last year, well, very strong, up 56%. Over the last 5 years, up 965%, an incredible stock over the shorter term. Also nice to note, over the last 4 quarters, they have beaten analyst targets, but what we do see over the next 2 quarters, negative growth, with it picking up in quarter 3 of 2025 as well as quarter 4. We do note March 26, 4.29 estimate on the EPS, with the forward P lowering down to 41.39. In terms of free cash flow per share, well, we can see it has been increasing over longer term, but it has been very inconsistent on a year-on-year basis. One thing we do like is the sales growth. Typically with companies, we see them very high and then decreasing. From the lows of 2020 at 6%, it has increased. An incredible year in 2024 at 77%. And no surprises that total sales are numerically more than 5 times growth over the last 10 years. Now, depending at which point you have been a shareholder, they would have diluted your position, as we can see, although it is very marginal increases year on year, plus the share price return probably wouldn't make you care about those increasing outstanding shares. ROIC, over the longer term, it does look good, but as always, we do ideally want to see minimum 10% consistently over the 10-year period. And in terms of margins, again, very inconsistent. It has been straddling not too far off the 16%, but in fact 15% in 2024. We would like to see that continue to increase from the lows of 2021. Free cash flow margin as well, something to bear in mind with this company, does look to be fairly inconsistent. Net debt to EBITDA, though, always love to see this as a decreasing metric. 0.75 in 24, 0.6 over the next 12 months. Always a good sign. Balance sheet does look secure. In terms of intrinsic value, well, $213. Now, this was an interesting one to do because ultimately the median rate of 30% would give downside of negative 10%. We have gone for the high rate of 35%, but bear in mind this comes to $213, and we can see Wall Street believe the share price to be even higher with 30% upside. They are really estimating a much higher growth rate than even the high growth rate of 35%. So bear in mind for today's episode of ELF, we have gone for what we would deem to be on the more higher side at 35%. But ultimately, we will put in a margin of safety At 10%, a buy at 190. At 15%, a buy at 181. And in today's episode, it isn't at that 20% level just yet. It does sit somewhere between 15 to 20%, but remember that is on the higher end of our DCF model. In terms of upside though, as we said, looking very strong at 30% according to Wall Street. And as always, you can grab a copy of this model to run your own numbers through, whether or not it's for ELF or any other companies that you do hold. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and as always, we'll see you all on the next one.